They told her no because she didn't own land. Meanwhile, she was sitting on $60K a month in subscriptions. What if that stream could be collateral instead of a consolation prize? Hi, I'm Glen Gould, and this is Capital Conversations. Quick preview. Today we're going to make the case lenders understand. No fluff, exact documents, the math you should use, and language you can say in a meeting that actually moves a credit committee. Here's the blunt truth. Banks still love land and buildings, but not every growth business owns property, and that doesn't mean you're stuck. Some lenders will finance predictable cash flows and enforceable rights if you present them as recoverable collateral. Quick reality check. Recurring revenue, assignable contracts, and IP. Those are the three I see move deals. Why? Because they answer two lender questions. Will this cash flow continue? And could the lender realize value if things go wrong? But before you prepare anything, decide who you're pitching. Different lenders ask different questions. Banks want repayment ability and low interference. Asset-based lenders want collateral you can seize and liquidate with minimal hair. Specialty funds will underwrite revenue or IP, but price for higher risk. Pick your audience, then tailor the package to what they actually care about. Let's inventory the assets you probably already have and what makes each financeable. First, MRR and subscriptions. These are gold to the right lender because they're recurring, measurable, and predictable when churn is low. Bring 12 to 24 months of transaction history and cohort retention charts. Show processor statements. Lenders want to see the money hitting an account. Second, customer contracts and long-term service agreements. The lender needs them to be assignable and enforceable. No oral promises. Signed agreements with clear payment schedules are essential. Also, check for termination on change of control clauses and get those patched if they exist. Third, intellectual property that generates revenue, licensing, royalties, or software with contractually recurring fees. IP without cash flow is hard to finance. IP with a royalty stream is financeable if you can prove ownership and enforceability. Bring registrations, assignment chains, and a short third-party opinion if you can. Other assets that work: inventory tied to sales velocity, merchant processor accounts, ad accounts that directly drive sales, purchase orders from creditworthy buyers, and trade receivables with clean aging. Each has governance needs, custody, reporting, or reserves, and each can be modeled in a borrowing base. Now, the part that trips founders up: valuation and documentation. Lenders want conservative, testable math, not optimism. For MRR, use an annualized formula adjusted for churn and a conservative advance rate. Think in terms of a borrowing base, not a venture multiple. For receivables, provide aging reports, proof of delivery, and remittance history. For IP, present an independent valuation or royalty analysis. Here's the paperwork you must bring: signed customer contracts, 12 to 24 months of processor and bank statements, IP registrations and an assignment chain, third-party valuations or auditor notes, aging receivables, and a proposed security agreement with an assignment clause. Also include a simple borrowing base schedule showing conservative advance rates by asset class. Lenders will pounce on three things: concentration, disputes, or a platform freeze. Put answers to those three in a short appendix and lead with them. It disarms the committee before they dig. I can't tell you how many times a founder loses a deal because a platform's terms allow withholding and no one noticed. Fix the contract language first. Get an assignment rider or a platform backup plan. Deal structures that work: a borrowing base where each asset class gets a conservative advance rate, a revenue-based facility taking a percentage of processor deposits with reserves for chargebacks, or a blended structure combining MRR and inventory with carve-outs so the business can operate. Be explicit about triggers and reporting. Weekly processor statements, monthly aging, and clean financials are common asks. Offer performance-based step-downs. Meet thresholds and liens stagger or release. That negotiation often buys you lower pricing or less personal guarantee exposure. Quick case study 1. A B2B SaaS company with 60K MRR, 90% retention, and low concentration. The lender used an annualized MRR borrowing base with a conservative advance rate and required assignment of subscription agreements plus monthly cohort reports. Result, a growth line without dilution and step-downs as ARR expanded.
The founder told me they nearly sold equity until the lender said yes, because the math was clear and the documents were ready. That's the difference preparation makes.
Case Study 2. An e-commerce seller on a marketplace paired inventory financing with control of merchant remittances and a reserve for chargebacks. The lender required inventory counts, warehouse receipts, and daily sales feeds. Outcome: working capital to scale marketing while preserving equity. Case Study 3. A contractor with long payment cycles factored verified receivables and carved out disputed invoices. The facility had a simple recourse clause and an invoice-level dispute process. It cost money, but it kept the business running without selling ownership. All right, practical checklist you can act on today. What do you bring? Contracts, processor statements, and an independent IP memo. That's it. Bring those first. Everything else is detail. Full checklist. 1. Assemble 24 to 24 months of transaction history and cohort retention. 2. Gather signed customer contracts and proof of delivery. 3. Pull processor and bank statements. 4. If you have IP, prepare registrations and a one-page valuation memo. 5. Draft a borrowing base schedule with conservative advance rates. 6. Prepare a one-paragraph pitch tying collateral to repayment. Say this exactly. We're requesting an X dollar facility secured by annualized subscription revenue, assigned customer contracts, and select inventory. Our MRR has averaged Y dollar for the past 12 months with Z% churn and no single customer representing more than A%. We propose a conservative borrowing base with monthly reporting and a reserve for chargebacks. This structure preserves equity while giving the lender a clearly defined recovery path. Before we close, 3 final takeaways. Lenders finance predictability and enforceability, not hope. Document everything and use conservative math. And structure deals so incentives align. Step-down liens, carve-outs, and clear triggers do that. Do those 3 and you change the conversation from maybe to how fast can we close. If this episode helped you, subscribe to Capital Conversations so you don't miss future funding playbooks and templates. The episode page has show notes and a downloadable checklist you can use in meetings.
Thank you for joining us on Capital Conversations. I hope today's discussion gave you practical next steps to make the assets you already own work harder for your business. Keep building. Let's talk capital. Until our next conversation.